At ground level, industrial operations are relentlessly chaotic. Materials constantly move through loading bays, heavy machinery runs at maximum capacity, and utility meters spin continuously. Contrast that operational speed with the reality of an executive boardroom. At the highest level, management deals in highly sterile, binary choices, shutting down an underperforming plant or signing papers to acquire a major competitor. Cost accounting provides the structural architecture bridging this exact gap. It serves as an active information processing system that translates raw factory output into clean corporate strategy. If a manager simply looks at unfiltered material logs, accumulated labor hours, and utility bills, they are looking at useless noise. There is no strategic value in the raw expenditures alone. Every branch of accounting requires data processing, but the requirement is particularly acute in costing, because this is where a company's real-time operating efficiency is measured and graded. We are going to build this information processing system from the ground up to see exactly how basic cost data dictates high-level corporate strategy. The ultimate goal of this system is to guarantee that no business policy is decided without accurate, perfectly tailored cost presentation. Mastering this architecture means replacing reactionary guessing with an engineered, mathematical approach to strategy. We begin by constructing the first layer of the engine, the input filters. Before any data can be analyzed, the foundational step is the rigorous classification and subdivision of all incoming operational costs. Raw overhead data flows in, and the system aggressively splits it into distinct pipelines. Costs are strictly categorized as fixed or variable, and controllable versus uncontrollable. Isolating these categories lets managers ascertain the profitability of specific activities, rather than using a single blended margin. This specific classification enables direct material control. The system dictates a maximum level for inventory, preventing working capital from being locked up. To maintain this, the purchase department uses economic order quantity, weighing order volume against storage limits for the most efficient purchasing schedule. But control extends beyond raw materials. The system provides the same continuous capacity checks on human labor and running machinery. By mapping the exact availability of these assets, workflow is planned so that no section of the factory is overworked and no section remains idle. Segregating overheads into strict categories isolates the precise variables that management actually has the power to change. Classification turns incoming costs from a chaotic force of nature into highly controllable, mechanical levers. We move to the second layer of the system, the calibration engine. Isolated data is organized, but it still requires context to be actionable. Management creates budgets, which serve as formal financial quantifications of their policies, thoroughly approved prior to a defined period. Alongside these budgets, they establish standards, precise estimates constructed specifically to measure future operating efficiency. This chart shows how the system actively compares incoming data. The flat baseline represents our predetermined standard. As actual performance numbers flow in, they track closely along this expected path. This brings us to the system's primary filtration mechanism for human attention: management by exception. The core principle of this practice is entirely ignoring areas of the business that are running smoothly and according to plan. Management bandwidth is strictly reserved for concentrating on the specific areas where performance fails to meet the standard. These focused performance reports facilitate immediate disciplinary or corrective action against the specific individuals responsible for the shortfall. This is an intentional design choice to prevent managers from being overwhelmed by the sheer volume of daily operations. Establishing these standards also provides the reliable, mathematical basis for all future planning and estimation. Management by exception serves as a structural firewall that prevents executive burnout, refining a flood of data into precise, targeted alarms. The final application of the system utilizes this filtered, calibrated data to drive immediate business policy and price determination. Take a high-stress economic scenario, a period of severe depression where market prices for your product are plummeting. This chart shows the fatal mistake of attempting to cover total costs during a severe downturn. When market price drops below that fixed line, the system throws a massive red warning. An untrained system mandates a halt in production because quoted prices are deemed too low. Our system enables a specific survival mechanic. isolating the variable cost line from the fixed costs to reveal a true bottom. A business must cut prices aggressively to stay competitive, but only to the exact extent that it recovers these variable costs. Maintaining operation at this variable floor allows the businessman to keep the facility running, remaining vigilant and tracking down concealed inefficiencies. Finding and eliminating these sources of wastage during a recession forces the overall cost of production down to its absolute minimum. If prices are fixed without this exact cost distinction, the prices quoted will either be too high to attract buyers or too low to survive. The separation between fixed and variable costs establishes the mathematical floor for corporate survival. Viewing the fully constructed information processing system from end to end, the mechanics of strategy become clear. By classifying inputs, establishing strict performance standards, and isolating variable costs, the architecture transforms operational noise into actionable leverage. The ultimate output is a series of specific, definitive decision nodes generated by management accountants for the executive team. This data dictates whether a factory should operate at full capacity or remain idle. It proves whether it is cheaper to manufacture a spare part internally or buy it externally. It dictates exactly when an underperforming product should be entirely discontinued to avoid a present loss. The system scales to answer complex growth inquiries, calculating if a new product should be introduced or if an untested export market should be tapped. These clean, binary executive choices are only possible because of the rigorous data segregation that precedes them. By indicating precisely where economies may be affected, the architecture ultimately ensures maximum output at the minimum cost. Cost accounting is the quantitative bedrock of executive action. Without this processing system, management is flying blind.